Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Verizon reported earnings last week, and there were three things that I loved about this earnings report. That's what I want to dig into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and check out my newsletter, Asymmetric Investing, in the show notes. If you like this video, I think you're going to enjoy that newsletter. And let's get straight to a couple of the really impressive numbers at Verizon. The first is Verizon's free cash flow. Now, this table that Verizon put out is actually for the first half of 2023. But if we look at operations from the first quarter, cash flow from operations in the first quarter were $8.3 billion. That means that second quarter cash from operations were up to $9.7 billion, a big improvement in cash flow from operations in just a single quarter. Capital expenditures, $6 billion in the first quarter. Given this number right here, that means that CapEx was only $4.1 billion in the second quarter, a huge reduction in capital spending in just a single quarter. Add those two together and you get free cash flow of $5.7 billion just in the second quarter. Now that's great news because there is a big dividend that Verizon has to pay. That amounts to about $2.7 billion for the quarter. So in total, you get $2.3 billion worth of excess cash that Verizon has after paying that dividend. Just a really, really great trend for the company's free cash flow. I think that's something that is absolutely worth highlighting. And if that improvement continues, even just a little bit, just by a few $100 million per quarter, both on the operating cash flow standpoint and then also on the capital expenditure standpoint, Verizon can continue to fund that dividend and actually improve the bottom line. The second thing is I'm going to add two things together. That is the dividend and the debt, because these two things really go hand in hand. Verizon has a choice what they're going to do with their cash flow. They could pay a dividend. They could pay down debt. Now there's a little bit of excess cash there. So 7.6% dividend yield. That's a really, really high dividend yield. The question is, can Verizon pay it? And right now they're generating more cash flow than they need to pay that dividend. As a result, this net debt number is starting to go down. Cash is improved. Management could actually pay down debt if they would like to do that. I think that would be a really great option here over the next couple of quarters. But this is really what we want to see, is an improvement in the amount of debt that Verizon has on the balance sheet, because that's what's ultimately holding back potential growth and investment in new growth opportunities. So the combination of that really strong dividend yield and a falling debt load are both, I think, really great signs for Verizon. The final thing is what I think could put Verizon in a really strong position long term to potentially even be the next bundle company, and that is broadband net additions. This is something I've been using for more than a year now. It's just a little box that sits in your house and it provides broadband, wireless broadband. So 5G comes in and then you display that broadband like a wireless router would. Very simple to use product, adding customers at a really rapid rate. 384,000 fixed wireless additions just in the last quarter. And this is the fourth consecutive quarter that there have been over 300,000 fixed wireless additions. So that is a business that I think is still really underappreciated by the market because it's very, very high margin. You're just using that 5G network that you already built out, and you don't have the same subsidies involved the way you do with smartphones. It's just a simple box that goes to consumers, not particularly expensive the way that a smartphone is, and it doesn't need to be renewed every couple of years. So you don't have the same hardware costs that you have on the smartphone side. So really great business. If that continues to grow, I could actually see Verizon being a place where they can bundle content together as well. That's a really interesting position because now you could be a provider of smartphone access, home broadband, and then even streaming content. That could be the next generation triple play, at least an option for Verizon in the future. The market hasn't been particularly impressed with Verizon over the last couple of years, but I think we're starting to turn a corner. And those are three things that I absolutely love about the company's most recent quarter: improving cash flow, the combination of a solid dividend and the ability to reduce debt or net debt on the balance sheet, and then also those broadband additions. I think that puts Verizon in a much better position. It may take a little while for the market to appreciate this stock, but with a 7.6% dividend yield and a single-digit price to earnings multiple, I think this is a kind of value stock that investors should keep in their portfolio. It may not beat the market by a wide margin, but if these operating numbers continue getting a little bit better year after year, I think the market will start to appreciate that. What did you think about Verizon's results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.